Kenna, we need to get your docs done so that we can get your product finished. Send me an email. I had to do that since you're here. But anyway, so as he said, I just retired March 1st as a Army colonel here at US SOCOM. I used to manage the SOCOM program objective memorandum, about $65 billion. And I'll tell you, lending is 10 times harder than managing $65 billion. But it's a lot of fun because what we focus on at ADPI Lending is trying to create the experience for our clients that we ourselves never got during our 30 years of military or real estate investing, and how you'd get one guy one day and then you'd never get him again, and you get the processing team from Wells Fargo, and those people, you'd talk to 7 or 8 different people and you never knew what was going on. And I vowed to create a different lending path for ADPI Lending. The big question you're probably all going is, why does this guy have any sort of knowledge in 4 months on how to be a lender? Well, I got lucky. I actually fell out of a boat and hit water. In March of 20, I reached out to Eric Upchurch, former dear friend of mine, actually former employee when we were in third of the 160th together. And now, ironically, I work for him. But I said, I don't know what I want to do when I grow up. And he said, I do. You're going to come work for us. We're going to teach you, train you. You're going to get your loan officer license, and you're going to work part-time for the last year, 18 months while you're on active duty. I got permission from the lawyers to do it, and I set out on my loan officer career. And in the first year, I part-time managed to do just about $17 million in business and was 6th in the company in production part-time. So who says you don't have enough time? Now, I treated it like a deployment. I sat my family down beforehand. I said, this is my future. I need this time to get established so I have credibility for my future capability. And I am going to get home, have dinner, go upstairs and work for 4 or 5 hours. And that's what it's going to be for the next 18 months. They agreed. They let me start it off, and it was the best decision we ever made as a family. So I transitioned immediately into the lending director position. And since February 1st, I've been kind of captaining the ship over at ADPI Lending, trying to, teach, coach, train, mentor, and provide resources and guidance to our ADPI community. So that's how I got there. And that's really not that exciting, but what I wanted to show you guys is there are ways to transition and be ready to make that transition happen. Obviously, retiring with 28 years, falling into that retirement check is a nice thing. And probably half of you on here won't end up doing that. And there's nothing wrong with that. Just make sure that your real estate potential, your cash flow dreams, and all things are set in motion before you lose that wonderful thing called a W-2 paycheck, because after that, lending gets difficult. And that's what I want to talk to you guys about tonight, is a little bit about what ADPI Lending is, what we can do for you. And really, then I want to kind of talk about some market conditions that are rapidly changing the landscape of your traditional non-qualified mortgage lending for investors. The first thing I'll do is I'll talk about how ADPI Lending is a full service retail bank. We do retail VA. We are about to finish our FHA certification, so we'll have FHA in-house. And we also do conventional primary residence mortgages on the retail side. Why is that important? As you watch brokering houses shutter their doors due to lack of liquidity, knowing that you're with a liquid retail bank means that your loan will close. And I know that some of you have experienced that. I'll tell you the stories of some of our folks who have been doing lending a long time, where they go to the closing appointment and the finance company's doors are locked, chained shut, and they're out of business. So I don't think we're going to see that. But what you have seen in the last few weeks is some very powerful mortgage lenders, brokers go out of business because they overextended their liquidity and their loans were called in by the Wall Street banks and they were unable to cover, and they ended up having to eliminate their workforce, most of the time over Zoom, followed by either liquidation in some sort of Chapter 11, 13, and they shutter their doors and stop doing business. So that's the marketplace we're in today. For those of you old enough to remember 2008, which I think there's about 3 of us in here, Christopher, I see 11. I know Bruce is the same way, but we're not seeing whole scale fraud, occupancy fraud, straw buying. We're not seeing those things. Thank heavens in 2008, the Graham-Liley Beach Act and several other lending things put things in place that make it difficult to get a loan when you're not the person with money, with income getting a loan. And I know that's frustrating at times, but it's done to prevent fraud and to reduce the cost of lending overall. So what ADPI and MNet also can do is we are a brokering service capability. We reach out to those non-qualified mortgage requirements, HELOCs, HELoans, and low credit opportunities, something below 620. We take those type files and we go find the broker that fits, that's the best transactional deal, financial deal for the client. And we go out there and we try and find the product for you to meet what it is you're trying to do. And then the other thing we do is we work with you to figure out what it is you want to do. And then we try and find ways to make that transaction happen for you. I've almost got an The other thing we've brought on is one of our teammates on the ADPI lending team is a hard money lender. He works for Prosper Firm, and he also is a mortgage lender that works for me. And so when we find great after repair value opportunities, 6-month IOs for purchase, and where you can, let's say it won't pass appraisal, needs a new roof, needs structural, you buy the property, you bring the repair money in, and you borrow against the after repair value. You do your 6 or 12-month repairs, interest only, and then after the fact, then you come back to us and we find you that 30-year fixed debt service coverage ratio or full doc loan, depending on your occupancy. So let's talk occupancy. Do I have any questions before I move any forward right there?
Yeah, there's one in the chat.
Okay. All right, LaDonna and Brian. Okay, so yes, your last mortgage you got with a company was sold shortly after you closed the loan. And the answer is yes. Very few lending organizations keep their loans in-house. A few local banks will. Some of your major lending institutions like Chase, Wells Fargo, they may keep a portion of their portfolio. But when I talk liquidity, if you have $100 million in liquidity with a mortgage company and you loan out $100 million worth of loans in a 90-day period, you have no money left to loan after that. You become insolvent. You can't loan anymore. So to remain liquid, mortgage companies sell theirs on the mortgage-backed security market. That's pretty much what drives our economy, if you ask me personally, is that mortgage-backed security market. And so what you get is you'll get a new servicing agent, and that servicing agent then is your interface to collect your payment, do your tax forms, manage your escrow, and answer your questions. Almost all loans eventually get rolled into a mortgage-backed security, and they're sold off as an equity in some sort of investment vehicle, a mortgage-backed security, 1,000 different ways to do that. But what you're seeing is the servicing agent change from who you bought it from and who is actually servicing the loan. Does that answer the question thoroughly for you? Yes, no, maybe? Okay.
Yes, that answers the question.
All right, great. It's not a bad thing. It isn't that your company doesn't like you. It's just that's how they remain. You imagine taking $100 million and loaning it out at 2.25, all of it to different loans. The company makes 2.25% over 30 years, and they can't do another loan again. So it's just how the mortgage industry works. All right. So I was talking about, help me here. I'm old. I forget where I'm at. All right. Well, I'll go for it. So for most of you investors, right? Most of you that are going to PCS or you're going to PCS back to the States. Let's talk that first. What's the best thing to do? Obviously, your VA is your best product on the market. No money down, lowest interest rates of all the products out there. And I'll talk about how you can reduce your VA funding fee. One, if you had a client save in the entire VA funding fee because he had gotten out, gotten a disability, gotten back in, bought a VA mortgage while on active duty and didn't pay the funding fee. So that's the first way to eliminate your VA funding fee. Second is you put money down. A lot of people don't know that your first use is 2.3% of the loan value. Your second is 3.6%, and all subsequent are 3.6%. Well, on a $500,000 loan, you're looking at about $15,000 or $16,000 in VA funding fee that gets added on top of your loan if you don't pay for it at closing, which is your option. How do you eliminate or remove some of that? If you're not disabled, second way to do it is put 5% down. That 5% down payment brings the VA funding fee from 3.6% down to 1.65. That's nearly a $10,000 savings in VA funding fee on a $500,000 mortgage, just for 5%. What that also does is it builds your equity and it also reduces your monthly payment. So that's a great way to leverage available cash to save yourself money in long-term debt, is to reduce your funding fee. Now, the next step on that is if you put 10%, it drops it down to 1.4. Not the big jump you're looking for. So evaluate your numbers, make sure that's where you want your cash to go to save that 0.2%. I will tell you in % of the times that 0.2%, you're not going to probably save that. What you could do with that money that you were going to put down, that 5%, can probably go to another investment vehicle, another investment opportunity, cash flowing property. Do your math, do your homework. And in the end, folks, interest rates, mortgages, it's all math. All right. How many of you remember mortgage rates above 8%? I don't see any hands going up in the thing. Listen, I do. My first VA loan in 1995 as second lieutenant Osterman was 8.25 fixed, or 8.25 variable 2-1, 30-year amortized that went to 10.5 in the first 2 years. All right. I refinanced it after 2 years at 8.25 fixed 30, and I was so happy. I know you're all like, this guy has already been drinking all night tonight, but you guys got to keep things in perspective, right? Most of you young investors remember 2.25 from 2 years ago, and your entire horizon is based on 2.25. Listen, 3 years ago this month, interest rates were in the 5%. And then our economy tanked because of this crazy COVID thing that I think Anthony sent over in some sort of letter he sent to somebody to give us all COVID. Our economy nearly tanked. Our entire economy, interest rates went to almost nothing. You weren't making any money in savings. We don't ever want to see our economy go back to that. Further put it into perspective, in 2006, before the crash of 08, the mortgage-backed security rate was nearly twice what it is right now today. When we look at the 10-year treasury yield, which is what drives mortgage-backed securities rates, your interest rates, when it goes up, rates go up. When it goes down, rates go down. In 2006, today it closed at 2.9, below what it opened at. So that was a good day. In 2006, that same rate was 5.6. So it was nearly twice what it is today. So you got to keep your comparisons in time valid to truly understand what your market does, where your market's at. So I'm sure somebody's thinking in their mind, Brad, where are the rates going to go? I'll jump on that question right off the bat. And the answer is maybe. All right. My crystal ball is in the shop. There's some part that's supposed to come from Taiwan. It isn't in yet. Can't seem to get it to work. It's cloudy. Batteries are bad. Listen, no one knows where this is going to go. I counsel my lenders every day about where we should be, what should we be doing. But I will tell you this. Our Fed's number one concern is inflation. We're at 9.1% going higher. Inflation, too much money, not enough goods to go around. It's the same thing in the housing market. Every one of you is trying to make that even worse by buying investment property and removing housing away from the demand for those folks that need primary housing, right? So inflation is going to drive the Fed to increase interest rates to get inflation under control because they need you to spend less money. Too much money, not enough goods. How do you slow that down? You spend less because interest rates are higher. Goods and services, goods really come back into balance. And then once they get that balance, then they can slowly roll back the prime interest rates. How does the prime affect mortgage-backed securities? I'll tell you, it's crazy to watch. The last Fed announcement where they increased it 50 basis points, I watched mortgage rates drop for about 4 straight hours. I was watching it tumble. I couldn't believe it. I was locking loans as fast as I could get them done for those clients that I had available. And then I watched it go right back up. And the next day it rates followed, but it was about a half a day behind. We are going to see another Fed rate increase. Anybody doubt that? Shake your head in the horizontal plane at this point. All right. Inflation is not curbed yet. The Fed has to do something and they have to do it quick, or you're going to see inflation rates in the 13, 14%, and mortgage rates will be above 10 before you know it. So we want the Fed to do temporary interest rate increases because that will eventually bring all of that back down. So where are your rates today? That's probably one of the burning questions for everybody in the group, right? Well, let me talk primary residence VA. I'm seeing 5.5%, 5 to 5.5% on average with a small point fee. What's happened with the volatility in the market, lenders are not giving par rates right now. Very few are. Now, there are a lot of mortgage companies out there that are going to discount your rate because they need the business so bad that they will take huge comp hits just to get the volume to keep their pipelines going. I encourage you to shop. I really do. I'm not always going to be the best rate. My lenders aren't always going to get it. But I'll tell you this, we're going to be at the end. We're going to be with you at the end when it's time to close. We're liquid, we're solvent, we're solid, we're good. I can't say that. I had a deal go bad this morning that's supposed to close Monday. A broker declined the loan at the clear to close because they obviously didn't want to fund the loan. So I'm scrambling with another broker to replace that financing for this client. Brokering deals is dangerous. Okay. I'm not saying it's bad. I'm just saying they don't have the backing of the federal government. They don't have Fannie Freddie rules. They don't have to comply with everything that your traditional lending process requires. All right. On the conventional side, usually at a half to 0.625. And that's, you're seeing conventional primary residence rates 6, 6.25, 6 1/8. And they're usually coming with about a third or a half a point to get that rate. So don't be surprised. Remember, recage your brain from where it was, where we were giving away 2.25 with lender credits, to where it is today based on market conditions. So try not to beat your mortgage lender up too bad. It's not his fault. He's doing the best he can to get you the best rates for what you're doing. Now, let's talk about investor loans. Because of all of the market volatility, for the second time in 2 years, Fannie Mae and Freddie Mac, your loan guarantee programs, basically eliminated conventional lending in the second home and investment home market. You cannot price out a conventional loan with a conventional lender on an investment home today. What they've done is they want to reduce the number of investment home loans in their portfolio. The Fed mandated it, so they put low-level pricing adjustments on those loans, and they don't pass the qualified mortgage check. So we legally can't even loan those to you. So those are off the market until we see a change in the buying habits and we see the portfolio balance with Fannie Mae and Freddie Mac. Probably a lot of technical jargon there, but the truth is the only way to get an investor loan right now is through a broker using either full documented or the debt service coverage ratio non-qualified mortgage product. Those products are almost identical to what you're used to in the conventional space, but they have a couple of differences. One, the rates are going to be higher because the risk is higher. Anytime you add risk to a product, the interest rate and the cost of the loan goes up. So a debt service coverage ratio loan, for those that you don't know what that is, it is an investor loan that qualifies on your credit score, the any homeowners association fee, and they take contract rent that you have on the property. So those 3 items can qualify anybody for an investor loan. We don't look at your debt to income. We don't look at your debts. We don't look at your income. All we look is that you have assets to close and cover reserve requirements, depending on how many properties you own, 3 months, 6 months, 9 months, and that it's liquid. So TSP, 401k, bank statements, right? So this is how investors who have multiple properties can continue to buy properties without affecting debt to income ratios. And right now, those are the best, really the only products on the market besides meeting that guy in an alley in a trench coat with a briefcase. All right. So any questions before I move on the debt service coverage ratio loan? If you have a question, pop it in the chat or just jump on.
This is Ann Brett. For those DCSR loans, do you guys offer those type of products?
We do, and we actually broker all our DSCR loans. And I have a stable of about 8 lenders that I routinely price against each other for terms and conditions. Some will do 80% loan to value on a purchase. Some will do 85. Some will do 75. A lot of it depends on your credit score, how much money you can borrow, what your loan to value will be. But you provide the scenario and I'll find the broker that best matches what you're trying to do at the best rate at the best price. So we do broker those files, and we are your loan officer if you come to us, and we stay with you from start to finish all the way to close. It's just, we're not the ones lending you the money. We're the ones making the transaction happen for you.
Awesome. Thank you.
And Anthony, you asked, do we have a lending sheet? We don't. I've asked Spencer Thomas for 3 months to get us one. Since he's an owner of ADPI, I tasked him to do that. So I'll take that for note, and we'll get a sheet out so that you can understand the difference in the type of lending. Julie, you asked, can ADPI do DSCR loans on Guam? I cannot. I was talking to Ann earlier. We are not, most American lenders do not do business in territories. And I've been working with Amnet Mortgage to try and find a brokering partner for Guam, specifically for our ADPI clientels. I have it as a task to chase down, and Ann and I are going to connect to see if I can find a way to use the services on Guam and somehow do a correspondent lender relationship with them to help out with that. But that's a good question.
Brett, so what for the DSCR loan, what is the average interest rate on the investment properties? Good
question, Han. It really determines, it's based on 2 or 3 key factors. One, your credit score. First of all, I struggle to find a DSCR lender that'll take anybody less than 660. If you're above 700, 740, 760, good credit with no late pays, obviously, on any mortgage products. I'm seeing it $150,000 loan and above, somewhere between, I priced one this morning at 7.49, and I've got others that are in the 8 to 9% based on credit score, loan amount, and whether or not the state allows and you select prepayment penalties. One way to reduce your interest rate with these loans is you take a prepayment penalty if your state allows it. 1 year, 2 year, 3 year, usually reduces your interest rate by about 0.5% for each year prepayment penalty. Now, does that mean you can't pay the loan off? No. Let's say you take a 3-year prepayment penalty and 30 months in, you got to sell this thing or you want to refinance it. You can do it. You just have to pay 6 months of the 36-month prepayment penalty in order to clear that loan from the file. So there are options out there. So don't feel like prepayment penalty is a prison sentence. It's just a way that you're hedging your bets to reduce your interest rates from the start. Does that help?
Yes. Thank you, Brett. I have another question. Sorry. So for the DSCR loan, do you think that is it easy to get lending for the short-term rental with the DSCR loan?
Good question. So I want to throw this out there because I know a lot of the ADPI community is all big on Airbnb, short-term vacation rentals, and I'm excited for you all. I have one in Savannah, Georgia. It kills me on taxes. I love it. But there's one lender that just came out with a loan that will qualify income based on short-term vacation rental income. And I have not priced it because I can only imagine that the pricing overlays are going to be above 10, 10.5, 11%. I will do that once they get it rolled out. But what all of your income is calculated on for this product is a long-term rent schedule. And I know that disappointing in some cases, but the truth is if when we order the appraisal, we'll get a 1007 rent schedule.
Yeah.
That's another document next to the 1004 that Bruce knows all about. And that 1007 is going to be the number that we use to calculate the ratio, which is the rent divided into the mortgage payment to get that ratio. Now, here's the cool thing. If you're going to do a purchase loan, you can borrow at 0.75, meaning you lose money every month on the loan. I've got DSCR lenders on purchase transactions that will borrow 75% loan to value at 0.75 ratio, meaning you don't make enough to cover the rent.
Yes.
Interesting, isn't it?
Yeah.
So there's a lot of opportunity out there. It's going to depend on those things I told you about: credit score, any loan below a 150, you're going to add interest rate to it because it's just a risk layering for the lender. Certain states will have risk layering. Love Texas, but darn, they kill me on some of their risk layering stuff. There's other states that do the same thing, but prepayment penalty will help you out. And then whether or not it's a cash out refinance or a purchase will determine really where your program parameters lie. And I've probably got 8 or 10 of those in my pipeline I'm working on right now.
Thank you.
Yeah, absolutely. So Anthony, you asked, does any long-term rental income include any income from partnerships like syndications, whether LP or GP? So if you're talking income for a traditional product, or are you talking for a DSCR or an investor loan product?
I'm talking, so you're talking like income is coming in from rentals that you had for long-term rentals, right? You have a buy and hold rental you've had for a long time. You're using that to be applied for your DSCR loan, right? What about any
Nope.
income that you're having from partnerships from a syndication as a GP or an LP?
No, let me clear that up. So the DSCR loan lives in this little bubble. The property you're trying to purchase, we figure out what we think what the mortgage
got it.
payment's going to be.
Okay.
And the rent that property brings in is the only two numbers that we use to determine the ratio. And then your credit score either qualifies you for it and it sets your pricing. So there's
Okay.
no external income required. There's no debt to income. They call it a business loan, investor loan, no income loan, because we don't care what you make on the side.
Okay.
It doesn't
I
matter.
misinterpreted that.
Yeah, no. That's a good question. I'm glad you asked it. Maybe I didn't say it right.
So then could you, okay, I guess follow-up question that, could you use that to purchase like a larger property, like a multifamily property, as long as it meets the long-term rental,
Absolutely.
I guess?
Up to
box?
4 units. Up to 4 units. Now, I just had a lender send me an email this week that they are starting a 5 to 8 unit loan program. I got to figure it out. And once I figure it out, we'll get it out into the ADPI blogosphere so you guys know we have the product available. But yes, 4 unit, no occupancy required on a DSCR loan. In fact, if you plan on living in it, I have to do a full doc non-QM, if you're not going to use a conventional or a VA product. So there's, it is a pure investment product just for you guys. McKenna, if it is established Airbnb, can you use that for the ratio? The answer is perhaps. If you've got 2 years of tax returns on it and a schedule, there are a couple of lenders that may consider it, but almost all of them right now are still using the 1007 long-term rent schedule to verify. And here's why. Because today you're the only Airbnb on that block. Tomorrow, every house is an Airbnb and your occupancy goes down to 20% of what it was, right? And so the lenders recognize, the brokers recognize that as risk. And so I've got one lender that will use Airbnb established income as the ratio qualifier. I have not used them yet. I need to dig in and figure out their term sheet so that I can provide that option. But I will tell you, it's going to be expensive. That answer? Good question there. All right. So Han, asking a VA loan question. If I buy a house in San Diego, how do you buy with the BH and the home price? So here's this is one of the most misunderstood scenarios that I see out there. There's so many lenders that say they are VA experts and not a single person on their staff has ever served a day in the military. I'll tell you, understanding VA guidelines is a critical task for success, and we do this very well. So I'm going to kind of work around this one for you. The first question, if you want to count multifamily rent on a VA purchase where you're occupying one of the 4 units, the answer is yes, you can do that, as long as a few conditions have been met. 1, have you been a landlord for 24 months or more? And can you prove it? If not, it changes how much of the income we can count. If you have, we can use up to 75% of the rent that's going to be generated by the other 3 properties. And you can actually add the entire amount above the mortgage payment into your calculating income. If you don't have that rental experience, there's a few things where they'll just basically zero out. As long as the rent coming in is at or above your mortgage payment will show up like this in your debt to income ratio, because the rent will zero out the mortgage payment. Is that clear as mud there? You're giving me a strange look. Okay.
Yes, but based on those, price in the area, the mortgage payment is around at least 5K and above, depending on what kind of price I buy. So let's say because when I look around, some, duplex or triplex is more than $1 million. Let's say if I buy it, let's say if I do house hacking, how that, how to say, mortgage payment will justify with my BH. Let's say if I can pay, how the lender will look at those,
Yeah, the lender's going to look at you as a whole borrower. Okay. He's going to take all of your income, all of your debts. And then if you're going to buy $1 million duplex with a VA and you're going to move into one of them, he's going to let you count 75% of whatever rent you're going to get off that other unit.
Okay.
He's going to add that to your income. He's going to add the new mortgage payment to your income. He's going to multiply those numbers and divide those numbers using his calculator, and he's going to spit out a debt to income ratio. And with the VA, I've qualified up to 80% debt to income ratio. VA is amazing. Conventional, 43, 45, FHA, 45, maybe 50 in certain scenarios. So it's going to come down to how much you have to pay every month versus how much money you bring in. If you ever want to run scenarios, shoot them at me. I'll run scenarios until your head spins and show you what those things look like, so you can kind of make those decisions moving forward.
Yeah.
Now, here, since you asked, I want to talk about the unicorn. All right. This is a great group, investors looking to renovate properties. The VA renovation is a unicorn. I've never seen one. I've heard they exist. I've chased the rainbow trying to find them. And I've got one lender that will do them. One. And there are so many stipulations on the VA renovation loan that I have never had a client actually use one. You can't buy any suppliers prior to the close. You can't do anything that requires engineering support. You have 4 months to complete all transactions from the time you close to the time the final inspection is complete and the final draw is made. There are so many stipulations on the VA renovation loan that almost nobody does them. And if you find somebody that does them, send them my way. I want to tap into that, because I swear 50% of the ADPI community asks about VA renovation loans, and I wish they were a real thing. I really do. Now, if you really need, there's 2 other scenarios where you can do renovation loans. One is FHA 203K, very simple, very involved, but very doable. And there's a whole lot of stipulations. There's some lender education, some builder education. You got to get all the plans built out. You've got to have all these things, and your timeline is 210 days to complete the transaction. And I've got a couple of brokers that I'll push FHA 203K loans out to assist somebody in a buy and renovate. Second way to do it is if it's just small stuff and you're getting a heck of a deal on the property, offer to pay above asking price and have them refund the money back to you as seller credits. That way, the seller credits can be used to do the renovations.
Yeah.
Now, the caveat to that is the lender can only loan up to the appraised value. So when the appraiser goes out, he's looking at the appraised value, he's looking at the comps, he's going to give you a value of the property as it is in the market space it's in, and all of those other things that Bruce can talk in great length about. All right. If you're getting a heck of a deal and it's way below what the appraised value is, you've got room there. So structure your deals to support your flexibility. Talk to your real estate agent, but make sure you understand the lender's only going to borrow up to the appraised value. Okay.
Okay. Thank you so much.
Yep. The third way, and I
Okay.
talked about it earlier, is hard money. Look at the property. Purchase it with hard money on a 6-month IO based on the after repair value. If you've got major renovations you need to do, that's a great way to do it, because you can get in, you buy the property, you get the money, you do the renovations, you put an appraisal on it, and then we do a cash out refinance on the after repair value that will basically cover most, if not all, of what you've already put into the property. You get a 30-year fixed term, whether it's a DSCR or a primary residence loan, and you can move out and move on to the next project that way. There's a guy in our group that does these all the time. Eris Panada. If any of you know Eris in the ADPI group, good guy to talk to. Ryan Fan does them as well. I don't know if any of you know Ryan Fan,
No.
but that's how you get renovation money, those ways. And I will never advocate for you to knock over a bank and use that, but that's probably the fourth way. So, especially in this market today.
Thank you.
Yeah,
Thank you.
absolutely. Okay, so we've covered conventional lending. I want to talk a little bit about FHA. So FHA has its limitations. It has its purposes. FHA will have income limitations and it'll have purchase price limitations for the county that you're in. Do your research, know what you can do and what you can't do. Here's the downside of FHA. 3.5% down's great, but there's a 1.75% upfront mortgage insurance premium that will roll into the loan. And then they will charge you generally about 75 basis points a month on private mortgage insurance, and it never goes away. So even if you hit 80% loan to value, the only way to get rid of FHA PMI is you have to refinance or sell the property. It is a vessel. It is a vehicle. It's a great one for doing short term when you know you're going to refinance it or sell it in a couple of years. You know, do your math, do your 2%, do your BRR. Okay. Do whatever way you guys do those things. Now, USDA, we're about to chase a USDA capability at ADPI. USDA, if you get on their website, designed for rural areas, they have a really interactive map that shows you where you can and where you cannot use USDA loans. They'll also do above 28 acres, but there has to be a structure on the property to loan against. So that's another method. USDA is zero money down, but it can only be used in certain areas. All right. Let's see, we covered now. So we've covered most of the lending products available to investors, homeowners, home buyers. You know, we've talked interest rates, we've talked trends in the market. Let's talk HELOCs, because I know that's another hot topic in the group. HELOCs. Okay. I'm kind of on the fence on HELOCs. A lot of you are taught in the house hacking method to cash out, refinance your equity. But I know it's hard to cash out a 2.25, even if you've got equity, right? It hurts because you got 2.25, keep it. But make sure that even if you aren't going to cash out, refinance that equity in a single transaction, make sure that when you do the HELOC, you capture what those costs and fees are. Sometimes it's a single draw where you can't draw for another 30 days. You know, just do your math. All of these things are math. They're not emotional. On a primary residence, except in the state of Texas, yeehaw, HELOCs are a great product to get equity out of a property without affecting your primary mortgage. Highly encourage you to use them. Do your math. And we can broker out HELOCs to multiple companies to help you out if you need it. But here is the sad truth of the current state of the market is there are no HELOCs offered in any product or with any lender that I've been able to find. Even Navy Federal terminated their HELOC product on non-owner occupied properties. There is not a single product offering for a HELOC on the market today. And that has everything to do with market volatility. We're watching diligently for them to come back, but I don't foresee them coming back in the near future. You're going to see an entire revolution of things happening in the market before HELOC products ever come back for non-owner occupied. But for that lucky person that's sitting on equity that makes sense to pull out 50,000 or more, and you got that 2.25 primary, there is a fixed product that I have a lender that does what's called a HE loan. It is a fixed 30-year second mortgage standalone. It doesn't affect your first product, and you borrow the equity for a combined loan to value between the first mortgage and the HE loan can exceed 80%. So you can keep your 2.25 on the primary. You can pull equity out in a single draw, and they amortize it on a 30-year fixed schedule. Those rates, depending again, are running anywhere from, a month ago, they were in the high 6s. Now they're in the 7s to 8s. And it really depends on your credit score and how much you're borrowing. But there is one product out there that I've been able to find to help you pull equity out of a non-owner occupied property without refinancing it. So that's probably some of the biggest information that I wanted to get out to the group. That pretty much covers the gamut from far left to far right on lending. So Montreal, could you use a HELOC on it as liquidity for down payment on a DSCR? Yes. The DSCR doesn't care where your down payment comes from because it's not going to look at your debt to income properties you have financed, and they will ask to see the mortgage payments and that you're current on them. But the actual DSCR does not care if it's cash from your job or cash from HELOC from liquidity on a primary residence. Does that answer your question, Montreal? Good, good. Montreal, we're talking tomorrow, right? All right, good. I think you got an appointment with me tomorrow afternoon. So, good, good, good. All right, awesome. So, Anthony, did I meet your goal and intent tonight? And did I get out what you guys were looking for on the lending side?
Yeah, absolutely. Yeah, I think this was an amazing topic and amazing discussion. I'm sure there's a lot more questions out there, but I think you presented a lot of options for people for sure. And I'm sure if you guys have any more questions, go ahead and drop them. I think Brad pretty much is done with his presentation. I assume, Brad.
Yeah.
Right?
Yeah. Derek, you said, does a DSCR care about owner financing or private loans on non-subject properties? I can say on the private loans on non-subject properties, no. Because remember, the DSCR is worried about the property and the money it's going to bring in and your credit score. And they need to make sure that you got reserves to cover, depending on how many properties you own. If you own 1 to 2, it's 3. If you own 3 to 6, it's 6 months. If you own over 6 doors, it's 9 months. I mean, I got to go back and verify those numbers, but as long as you've got the liquid cash to close and to cover reserves, doesn't matter. Doesn't matter at all. So now, owner financing, can you give me a little more on that? Because as a lender, I don't play in the owner financing game. That never comes across my desk. So, can you give me a little more on that question?
Yeah, are you there? Can you hear me?
I can.
Yeah, so it's a property that we bought from my wife's mom. She basically is the bank for that. We pay her a mortgage every single month. It would be a non-subject property, so we'd be doing a DSCR loan on another, obviously. But you mentioned the financing terms for the DSCR loan.
Yeah,
so
no,
that's
absolutely.
why
So
I'm
private
asking this question.
financing, public financing, whatever you want to call it, you've got a mortgage statement you've got a contract with your private financier, right?
Yes.
Show the mortgage statement, show the contract. Yes, I'm making payments. I'm paying my mortgage. I'm up to date. I'm good to go.
Perfect. Thank you, sir.
Yeah. Absolutely. VA loan limits. Kyle, good question. Do you have specifics or do you want me to just go over how the entitlement works?
I have a little bit specific, but maybe maybe this is part of like the general and how entitlements work. So from understanding, the loan limits differ depending on the area's value of homes. So like for Guam, it's 970K. For North Carolina, it's 647. Theoretically, if you bought a home in Guam for 647, and that's the limit for North Carolina, you move to North Carolina, you wouldn't be able to buy anything else there, right?
Yes, you're correct. So the countywide loan limits are what determine what a VA loan can utilize. But I want to take a step back. I want to kind of surprise you a little bit. For those of you that have never used your VA loan, there is no upper limit. In 2019, Congress enacted a law, and it went into effect in 20, that for the first use of a VA loan, there is no countywide loan limit. So if you can debt service a $2 million 4-unit, the VA will lend to you. It's quiet out there. Shocking, isn't it? Now, the minute you use your VA entitlement for that $120,000 property in North Carolina, your limit is now whatever the countywide loan limit is for all of the counties under the FHFA rule. So if you're going to use that VA loan limit and you haven't used it yet, think hard and long about how you want to use it. Can you ever get that back? The answer is yes. There's a one-time restoration where, and there's differing opinions here, and I'm getting differing viewpoints from different VA loan centers. So I'll talk in general. So in order to get your unlimited use VA loan back, you have to satisfy the debt on that original loan. You can't, how I interpret it is you can't refinance it. You have to sell it or pay it off with no other financing vehicle. Okay. You submit for a one-time restoration and you get your unlimited entitlement back to use one more time. Now there's some out there in the blog sphere that say they've gotten away with it. Listen, great, good for them. I can't guarantee it, so I don't put it out. But once you use your VA loan limit, you've now capped yourself to whatever that FHFA limit is. 647,200 was this year's limit, first time it's been raised in years. And you're right, certain markets, San Diego, Baltimore, the Northern Virginia, 970, 800 is that limit. And you're right, Kyle, going back from a high county limit to a low county limit, if you used it in Guam and you use more than 647,200, you have no VA entitlement left.
So it switches to whatever county you're currently in.
Yes, sir. It does.
Okay.
It goes to the county the purchase location is in. Now, let's reverse it. Let's say you bought that $120,000 loan in North Carolina and you're going to Guam. Well, guess what? You've got $850,800 in entitlement left to use in Guam. Because you just
Right on.
subtract what you used from the county loan limit, and that gives you what balance you have remaining to utilize your VA loan. Now,
Gotcha.
that right there is how people get 1, 2, 3, 4 VA properties. Is they PCS, they buy small value properties, and then they suddenly find themselves in Northern Virginia and they buy a $500,000 house because they have that left. Now, here's another one for you. What happens if you're short entitlement on this transaction? Does anybody want to give me the answer there before I give it to you? Anthony?
You just
25%.
pay the down payment, cover the down payment yourself.
I
Sort
heard-
of.
I had 25% of their above value, above
Correct.
amount.
Correct. We do math in the calculator. We figure out what the VA entitlement gap is. Let's say the gap's 100,000. You pay $25,000 down, and the VA will cover everything up to that amount for you, everything below that. So you pay the difference at 25 cents on the dollar for any amount over your remaining VA entitlement. Now, I highly encourage you to let someone who knows what they're doing do this math, okay? So that you don't make a mistake and you're not in the lending guidelines every day and you're not in the VA lending charts. I've got a great little program that does this for me that I use to make sure that we're good so that we don't under or overestimate capability. That is how you do it. And I will tell you, there's a lot of people in the ADPI community and the 60,000 members that think they know that answer. And I watch it all the time where they're not quite right. So make sure before you pull the trigger, that you talk to a VA lender, someone you trust, someone you know knows how to do math, and make sure you know the answer before you step out on a transaction.
Perfect.
Good question.
Hey, everyone. So we're at the bottom of the hour here. I'm going to go ahead and leave this open for the next 10 minutes. But if you guys have questions, if I could ask you to raise your hand or just say it out loud. And if you guys want to drop your contact information, emails preferably, in the chat here now, so everyone can start gathering it here. But if you have a question, go ahead and say it aloud to Brad, and we'll just do questions verbally from now on. But thanks everyone for joining. If you guys have to jump off now, but Brad, if you want to stay on for a few more minutes, if people have more questions, I know we started on with you a little later. So we did. It looks like we have one more question in here from Macazin. Where do we start as absolute beginners?
Oh, I'm not going to take that one. That's on you, Anthony and Anna. And
Are you asking that from a lending perspective? Where do we start as absolute beginners? You want to take yourself off mute and ask that question?
if you're talking lending, I'll go ahead and jump out in case that's what you're asking. We're about to publish a first-time homebuyer guide that we've been working on. Tim Kelly and I and Eric have been working diligently on to kind of provide a roadmap. But the truth is find a lender, okay? Find 3 lenders, whatever. But just find somebody that can walk you through what you're trying to do and get pre-approved, all right? Before you even do that, make sure you know what your credit looks like. Get your finances ordered, get your credit balances below 30%. Don't open up new trade lines. Just work on yourself and then find a lender, get pre-approved. Once you know what your limits are, what your capabilities are, then you can step back and you can start doing your BRRR calculations, your cash flow calculations that they teach you in the ADPI course. And then you know where to step off from there. And like I said at the beginning, I encourage people to shop, but I want you to make sure when you shop that you understand apples to apples. Lenders will give you loan estimates or they'll give you rate quotes, and they won't tell you everything. They won't tell you what discount points are coming in. They won't tell you what fees, what costs. They'll leave off taxes and insurance, and they'll give you information that isn't necessarily wrong, but it's not thorough. One thing we offer at ADPI Lending is if you get an offer from another lender and you just want somebody to take a look at it to make sure it's straight, send me an email. That's my job. My job and part of ADPI is to make sure you guys don't get taken advantage of. And I tell people every day, listen, I'd stay with that one. That's awesome. I just did it yesterday. No way I could beat this. I don't know where this guy found this rate, but I told him stay with it. I'll keep your file open in case they go out of business and close. I'll swoop in and save the deal like I do probably once a month with somebody. But if it's a better deal, I will absolutely tell you to chase that dream, because I think like a fiduciary, because I was in your shoes many, many moons ago. And I want to make sure you're getting the best appropriate financing for what you're trying to do. Does that help? Does that answer the question you're looking for?
I would say so. And I'm glad someone asked that because yeah, I think a lot of when we were doing the breakout rooms, I saw a lot of people were had yet to even purchase their first home. So I think you addressing that question was really good to give them, here's what you should be thinking about. Here's the things that you need to focus on before you even, take that first step with the lender. And I definitely agree with the whole lender thing, just because there's so much intricacies with the lending piece, and you really don't want to do that part. You want them to do that part. That's their job.
Yeah, I appreciate that. The other thing that I'll tell everybody is, look, you can chase the lowest price, you can chase the lowest rate, and you'll get just that. You get what you pay for. I will tell you, and again, I've admitted from the front, I'm not always going to be the best price, but what you're going to get is you're going to get clarity, communication, automation, trust, and know that the lending team from ADPI knows what you're doing and knows how to get you there. We're not just some internet bank that's just trying to get you. Another thing I'll tell you is protect yourself. There's a few things out there that you can do to protect yourself from credit fraud, predatory lending, and that is optoutprescreen.com. It's a Consumer Financial Protection Bureau website where you can go and you can block the credit bureaus from selling your information to mortgage companies, car lenders, all of the different people. And it's a 5-year block and it's mandated by the CFPP. It's in my email. If you ever get an email from me, I put the link in my thing. I encourage you to also do the do not call registry for every phone number you have in your family. Protect yourself, because the minute your information starts to get out there and they start to put different things together, that's where credit fraud comes in. That's where identity theft comes in. So take every step you can to protect yourself. And then if you don't know what your credit looks like, again, the CFPP mandates that the credit bureaus give you one credit report free each year. You don't have to pay for it. You don't have to subscribe to a service. Freecreditreport.com, and make sure it's the CFPP website one. You get one free credit report from each bureau each year, every 12-month period. Do your homework, protect yourself, find somebody you trust and that speaks your language. There are so many things out there in lending that most lenders don't know about. Like for those of you with BAH, Oconus Cola, BAS, did you know that those show up at 125% on your income calculation? They're tax-free. So your income is actually higher than what your LES is showing when you're looking at a lender buying an income-based loan product. I don't know how many times I've gotten loans where they've fallen apart, and just because the lender didn't know that they could plus up income, and they're DTI qualified, and we got them into the product. So find a lender you trust. I will tell you, if you race to the bottom, that's what you're going to get, if you get anything at all at the end. All right. It's a volatile market. Make sure you trust your lender.
Looks like Kyle had a question.
I do. So I've only heard of this one time before. I have a friend that's trying to accomplish this in California right now. I just want to see if anybody here's heard of doing this. So I have a buddy who's got an agent that's walking them through the process of using a VA loan and an FHA loan at the same time for 2 different properties. And the reason they're allowed to do it is because the properties are far enough apart from each other to both count as primary if he travels for work. Has anybody here heard of that or considered doing anything like that?
Anybody? Bueller? Yes, Kyle, it is possible now. But here's the thing. The lending guidelines aren't real clear. All right. You can get 2 VA properties at the same time, both as primary residences. And you can get them in the same town. Now, caveat that with extenuating circumstances. What you do is you present the situation to the VA lending, the underwriting team through your lender. We submit a request for a scenario eval. Let me give you an example. I just got this one. We're in escrow right now. Guy's on a deployment. His mother and his sister live in a house. 1,300 square foot house. When he gets back, his fiance and her 2 kids are moving into a property, and he works in that community, right? He's National Guard activated, coming back. So he needs a bigger place, doesn't he? He's getting married, change of circumstance, extenuating circumstance, larger property required. I wrote it up, sent it to the VA. The VA was like, yeah, he's fine. He's got entitlement left. That totally makes sense. He's buying a second VA property within 2 miles of his first, and he didn't PCS to do it. Now, Kyle, back to your scenario. Just because you travel for work, you have one primary residence. That agent's going to get bit. You're on the verge of occupancy fraud there. And because you're doing it between 2 different types of products, they might get away with it. But when you sign that VA form that says, I intend to occupy, that's what you're saying. And if you sign the same document for FHA at the same time, you're committing occupancy fraud. So make sure before you do any difficult multi-property scenarios, that you get this blessed off by the agency that's underwriting that deal. Let me ask you this, Kyle. Does it make your hair stand up on your arm just a little bit thinking about it? It should.
When you say the word fraud, yes.
Yes, because that's what it is, right? Because when you sign your VA, everyone that's done it, you've signed that VA occupancy addendum that says, yes, I intend to make this my primary residence. You have up to 60 days, right? You actually have longer than that, because if you're deployed and you're coming home in 9 months, but you want to buy the property ahead of time, fine, as long as you can carry that mortgage without in your debt to income ratio, you can buy it 90 days, 120 days. You just can't rent it. So when you sign that occupancy form, you're saying, I am occupying this property as my primary residence. So in your scenario, which one of those is his primary residence?
The way he was making it, so I don't fully understand it. So I'm gonna definitely like try to get more information on it. But the way he was making it sound was he has to live in 2 different locations for work.
There absolutely may be a valid reason. I'm not saying it's a no, but I'm saying that is right along that line. As long as he can show that he has to maintain separate residences for work and his debt to income can cover it, he may be able to pull that off.
Gotcha. Yeah. So I was thinking like along the lines of like, if I have one obligation stateside and one in Guam, if I could maybe pull it off, but I'll
Okay,
definitely do more research.
So if you are PCS to Guam, the answer is no, because your primary residence, whether it's the barracks, whether it's a van down by the river, whether it's the house in Guam, is your primary residence. Anything else is considered a second or investment property in that
Gotcha.
scenario. Yep. Because you're not traveling on Tuesdays to San Francisco for work, are you?
I'm actually separating, so there could be a possibility where I could have like one job that's remote, kind of stateside. I go visit that job. I'm just kind of like playing around with theories.
Yeah.
I don't have anything set right now, though.
Yeah. Kyle, send me an email and let's talk through and let's see what products and opportunities are out there. Because the other thing that we're struggling with in the military is when you separate, the minute you have separation orders, you no longer have verifiable income, do you? Your income stream stops and it doesn't qualify out the 12 months. It's one of the biggest jokes of the lending gap. And unless you've got an offer letter with a start date and we can get a pay stub, we're kind of screwed, aren't we? Because that great active duty income we had disappears the minute we separate. So I tell everybody, listen, if you don't have orders and you haven't submitted for orders, and your enlistment, you can still qualify to re-enlist. You might want to consider buying it as an investment, or, and that's where we get into everybody's individual scenario, because I don't want to put out blanket things that say, oh yeah, you can do it and you can't. It's individually independent. All right. I could tell you 1,000 different scenarios. I've got 30 loans in my pipeline and 31 scenarios. Everybody's lending situation is different. So, but just be careful. Occupancy fraud is bad for you and for your lender. Your lender loses their license for life and you lose whatever they can call the loan in, and you have to pay it off or you lose it. I mean, there's a lot of bad things that can happen when it comes to occupancy fraud. So be very, very diligent in that.
Thank you.
Yeah. Somebody give me a happy topic to close the night on, please.
Julie, do you got one for us?
Yes.
Go ahead, Julie.
If you buy a property under market value with your VA loan, like say the property appraises for 500,000, and you buy it for 350, can you still go to closing asking for an extra $50,000 to put in your pocket?
No. And where's our appraiser? I need him to turn his hearing off. So no, you can't, because your contract price is what your loan value is going to be. You're just going to get a great rate
Okay.
because your loan to value is like, 55%. So your rates are going to be lower, your costs are going to be lower, but no, it's going to come in that case, Julie, go back to what we talked about earlier. If it's a $500,000 property, write the contract for 300 with $50,000 in seller credits, or 4% is the max for VA, 6% is the max for conventional loans. So do your math. You can also get what they do is they say, let's say you put 10 grand in earnest money down. You get your 10 grand back automatically, and then the 4% starts. So that's how you get additional equity out of an undervalued property, or an overvalued property in this case. But no, you can't purchase price of 250, borrow 300. It goes
Okay.
strictly on the purchase contract.
Okay, thank you.
Yeah. And again, work your scenario with your loan officer. They're going to get you the right place. And if they tell you it can't be done, find another one and make sure.
Awesome. All right. Hey, thanks everyone for showing up. We're about 15 minutes past. If you want to send your more questions to Brad, I dropped his calendar and his email again here at the bottom of the chat. So feel free to set up a consultation with him or shoot him an email there. I'm going to leave the chat open here and the Zoom open for another 5 minutes or so. So if you want to drop your emails here, if you have anything else, you want to grab somebody else's email, feel free to do it here. But hey, Brad, thanks for popping on here today and sharing your wealth of information. I definitely learned a lot, and everyone else, thanks for showing up here. I think this was a resounding success. I think Ann and Brad. So thanks everyone for showing up. And I think Ann, a month from now is when the next one we're planning to do for deal analysis. Is that right?
Yeah, we do have a lot of things that we still need to talk about. This was the first one, so we kind of wanted to, see what we can do, and then we'll kind of back brief and see what we could do for the next one. But yeah, we'll just for everyone's knowledge, we'll be figuring out, the topic is deal analysis, or how to analyze a deal, I think is what our title will be, and the date will be in August.
Perfect. Awesome. Yeah, and feel free to reach out on ADPI if you guys have any questions on anything. And Brad is again a wealth of knowledge. And thanks everyone for showing up. Again, I'll leave this open for a few more minutes if you guys want to drop your contact or take more information from everyone. So thanks again for showing up on a Saturday morning, and have a great rest of your weekend. Thanks everyone.
Thanks for being ADPI members.
Absolutely.
See a lot of names I recognize in there from the Facebook group. It's pretty cool.
Absolutely. Yeah, we had a lot of our hosts were showing up here. Derek, Kyle, Ann, Han was one of them. I'm trying to see who else. Yeah,
McKenna, let's get that appointment done so we can finish this up.
Yes, I understand.
Hey, and thanks for the introduction to Walter. Things are going well there too.
Yeah, he's actually, so we're actually trying to partner.
Good.
Possibly. Yeah, he's a good dude.
Yeah, I'm actually trying to find a HELOAN lender in Wyoming, but I haven't been able to find anybody. I've been through 32 different brokering houses. I'm working on one other option. I'll know next week if I can help him out with that. But,
Cool.
Yep. Yep. And you got my note about the other one, right?
Yeah, I need to go to the embassy. I need to figure out how to do that.
You can go to the consulate, the embassy. If you get reach back to them and you've got a legal affairs office, they'll usually let you use that. You just got to tell them and give them the notary information. They may let you use your legal affairs clerk if they're notary capable.
Yep. Understood.
All right. Cool. I know it's tough to get a hold of you sometimes.
Yeah, sorry.
That's all right.
All right, take care.
See you guys.
Brad, where in Wyoming? Cheyenne, I'm guessing?
I'm trying to remember, I don't remember what city one of my clients looking for. But I'm looking for a lender that can do a non-owner occupied second standalone mortgage. Most of them will do them as combination where you buy it and then you get a second, right? In this case, I'm looking for a lender that'll just do that second standalone. And the one I use doesn't do Wyoming. So I'm looking for that one, but I've got a line on a company that may, and I'm just not sure yet. It's such a unique product and no one's doing it except for this one lender and they're doing really well at it. And I keep telling my other brokers, I'm like, why aren't you doing this? And I can hear them scratching notes. I'm going to find out why we're not doing that because that sounds like a great deal in this market. Because I mean, you don't want to give up that 2.25 to get your equity, right? That's an emotional decision that's very, very difficult. But I tell everybody it's math, people. Your ADPI people. Don't let your emotions, make you lose cash flow opportunities or equity miss. Because remember, equity locked in the wood paneling of your house, or in Christopher's case, the pink wall behind him, equity in the wall isn't quick. You can't jump on a deal when the equity's tied up in the home you're living in or the home you're renting out, right?
And just
Having
for the
that
record,
equity-
that's salmon. That's salmon. That's not pink. That's salmon.
Okay, salmon. Puce, salmon, something like that. Good. Yeah, but yeah, that's good. What other questions you guys have? Listen, I do this for a living, but I do it for fun, and this is my commitment to the ADPI community. Is my time.
Brad, I'm
So-
curious. Do you know have you heard of anyone doing a third VA loan? So if
Yes.
someone, okay,
Yes, it comes down to math. How
okay.
many of them can you